Hello and welcome to Market Matters presented by MyX. I'm Joe Teague of Equity Armor Investments. With me, as always, is Brian Stutland. Happy Monday, Brian.
Yes, happy Monday. We're back in action again. Love it. Back from the weekend. And speaking of action, it's actually been a pretty wild ride. As we like to say, markets can actually go up and down, and it feels like all at the same time. If we look at what the S&P 500 and stocks have done over the last few weeks, obviously November has been off to a great start for traders that are on the bull side of things, and we've really seen market move. But, I thought what was most important as we sort of get into it here, Joe, is when you look at the sentiment, we like to look at some of these indicators, you and I, when we're trading these markets and see as a sort of a contrarian or so. I think it's interesting if we sort of bring up a slide here on what the market's been doing. Maybe, Joe, you can comment on where you see market sentiment going and what that means for the markets.
Yeah, and as you guys all know, followers our show, we are market makers, former options market makers. So it absolutely does behoove us to be contrarian. So that's what we are. That's what we do. And we brought this up last week, and I thought this was fascinating. This AAII market sentiment, there was just a massive shift. So 2 weeks ago, the market was looking very bearish to start the month of November. We had a weak September, a weak October. The market was just in a nosedive ever since the end of July, and it reached a peak in the bearish sentiment, and it was close to a 52-week high. It was the high of the year. The lowest before 2 weeks ago was the end of 2022. So everyone was piling in short. They were buying puts, and that was obviously the floor, the short-term floor in the market. And we saw a massive shift in just 1 week. In just 1 week, we went from 50% bearish to only 27% bearish. That is a huge shift. And we went from 24% bullish to 42% bullish. Now, this isn't quite the level where it will signal contrarian indicator where, hey, I need to start getting short maybe, or this is too bullish. I need to think the other way. But this is definitely a big shift and something we need to be watching going forward.
Yeah, and certainly we saw the S&P basically, move 5-6% in a very short amount of time. So it's easy to see people just sort of get run over to the upside of anybody that was sort of using protection at the time. I know for us, Joe, we talked about it ourselves. We took some of that protection off, so to speak, reshifted our positions to play for this move because it did seem a little bit overdone to the downside. And historically, seasonality, the last couple of days of October, the first 3 trading days of November are very bullish for the market. Now we've gotten through that. We'll see how things digest and where they move from here.
I remember last week we were talking about this shift. We were saying bulls to maintain control. What we expect is on a pullback, they'll buy it. We definitely saw that last week with the big rally on Friday.
Yeah, I think will be interesting. Actually, last week was last week. Now this week, though, I think we had a lot of Fed governors speak last week about inflation, talking about data. We had a lot of volatility movement. I was looking really at the spikes and where option trades were being placed, sort of as we saw this bear bull sentiment shift. And when we look at the spikes index, which is a volatility indicator on the SPY ETF on the S&P 500, we really saw option prices compress. Remember, the spikes is sort of this indicator at any given point. How do 30-day option traders view where those price of premiums are at on SPY? And we saw the spikes really get crushed as the market rallied. And we're now really kind of in this area around this 14 handle level here in the spikes where, if you look over the last few months, that's been a buy opportunity in terms of buying option premium. So I've really been taking these last few days here to look at areas where I could look to buy some options, whether I'm going to play to the upside with a call or buy a put to protect on the downside. We're sort of in this level where it has made sense to own some level of volatility in a portfolio as a hedge. Joe and I, we're long short traders. We manage a couple strategies that do so. And now's the time sort of to own option volatility. I don't know, Joe, what you're seeing here in volatility space.
Yeah, and this coincides exactly with what our strategies are. We like to load up on volatility when it dips down to these levels. Definitely, we'd be looking in here at this 14 area. Below this 14 area has been a buy in 2023. We get a little confirmation of a higher relative high, then it really starts to take off. So that's what we're watching for. That's the reason why we watch volatility. Again, we we love to load up on it when it's low. We ease off the gas when it starts to go up, and then we start looking other areas of the market which are at a reduced price.
Yeah. And I mean, speaking of low volatility and buying options, I mean, we have a very busy week this week. The CPI number coming out. Everybody's been watching inflation, right, Joe? And interest rates have moved just about as volatile as the market, which is usually, not typically seen. The level we saw the 10-year go from above 5%, dropping now below 5%, moved about 50 basis points in a week's worth of time. And the CPI number is going to be pretty big. What do you see here? We're expecting that 0.3% gain month over month, but what do you expect to see from CPI and what that means for the market?
Yeah, so this is going to be really critical. The last 2 years, the market has had big moves off of these inflation data points. As an economist, econ graduate, I shouldn't say I'm an economist, but it's really fun to see the economic numbers come into light. People are really trading off of them. There was a time when interest rates were super low and nobody cared about these numbers, but it's fun to watch the reactions to it. And actually, we've seen the trend of inflation coming down and down and down. And since the start, the survey of Bloomberg economists had said for the Fed to stop their tightening cycle, for them to stop raising rates, they would need to see 6 consecutive months of CPI of either 0.2 or 0.3. The projection tomorrow is 0.3. If we get that or lower, then we'll have 5 straight months of 0.2 or 0.3. So we'll be getting very close, nearing the end of the Fed tightening cycle. So that's something the market is looking forward to. They really got ahead of the game on the last Fed meeting, and they've really been rallying as the 10-year rates have come down significantly just in the last week and a half.
But Joe, I mean, 0.3 times 12 is 3.6, right? That's still above the Fed's target that they've said is 2%. Do you think that's going to be an issue? Or are you comfortable with seeing that print of 0.3%?
Well, I think the market's already given up the ghost. The Fed's going to actually get inflation down to 0.2 or 0.2% rally. Even at 0.2, like that would still be 2.4%. That would still be above their target of 2%. So I think the market is just saying, you know what? 3%, 3.5%, that's going to be what we're going to have to live with in the short term. And it's going to have to be good enough. And if we can do that, we expect the Fed to be more accommodative than they have been lately. So,
well, okay. I mean, if that happens, I mean, I kind of have a trade here. I mean, we like to give something actionable for people, right, to sort of trade off of. And I'm kind of looking here at the S&P 500 as maybe a way to sort of trade and play this to sort of, I like to say risk less to make more, and so to speak. This is maybe just more to put some protection on. We talked about the spikes getting down to that 14 level. That's a time to buy options. You look here, the S&P 500 index, we sort of saw this big head and shoulders top that occurred a few months ago, and it sort of broke down below that neckline that us technical traders like to talk about. Now we've made what, if you really want to dive in, is the Fibonacci retracement of 61% from that low to high that we recently saw. We're right back up here. This 4,400 mark is really sort of critical. I sort of expect some consolidation to occur here, but I expect the market to move pretty big off these levels as we head into the end of the year. And so when I expect a decent sized move, I'd like to just, drill down a little bit. Let's look at the 60-minute chart here and what's done and see what the right trade is here. You saw the market sort of fall apart at the end of October. And as we started to turn the corner on the month and the page, November, we ripped higher. This right here is looking at the S&P futures contract right above this 44.10 mark. It's kind of hung in there. Today, the markets were down to start the day today. And then all of a sudden we bounced off that 44.10 level and have kind of moved back to the upside. So there could be more upside to come. Joe talked about that 0.3%. What if that CPI number comes in at 0.2? There could be more upside of this market. So what am I going to do? I'm going to use a call option and play to the upside here. I'm looking out to December, the 3rd week option trade, and this is something in the SPY, so pretty cheap option prices right now. I look out to December, that 3rd week expiration, the 445 strike call. This is an option trade I might look to put in order to sort of continue to play the upside. The market's already made a big move. I don't want to get necessarily just long the market here, and then all of a sudden we hit this sort of critical support resistance line and then decline back down again. So here I'm only going to risk a little bit of premium here on this, a little over $4, and then right there you can see sort of the break even to the upside. So with the call option at the 445 mark, I'm basically only outlining that premium of that call option, And once we get, the strike price plus the premium of the call that I pay above that level there and beyond, I have unlimited profit potential. And I'm only risking about what would be 1% of the value of the stock, a little bit more than that. And so I price it like as if I was going to buy 100 shares of SPY. I would use one call option to do that. And that's how I want to play this market at this point.
So is there something about the December expiration that you like more than any other?
Well, I think when you go about 30 days, we talked about the spikes. I looked at implied volatility. Trading around that 12.5 level is very cheap for an option trade like that. So, there's still some volatility baked into this market in the very next week or daily options that maybe we don't get through that break even. But I want to give myself a chance to sort of work through this trade and realize all the upside profit potential if I'm right about this.
Yeah, I like we got the CPI coming up that should be a little volatile. We'll have a December jobs number, some more volatility, and of course, you're just kind of playing the year-end rally, kind of continuing the trend. Even if we do get some consolidation for another week, there's still plenty of time for this to rip to the upside. And again, you're risking 1% outlaying here. If you're owning SPY, if you're owning the market here, we just saw a 7% rally or 6% rally off the low. So it's very easy to conceive you could lose 6% to own the stock. So this is why we love options. You can have a risk-defined trade. We know what we potentially can risk, and we're able to still capture that upside just the same. So yeah, I do like that trade, and it does make a lot of sense to me. I think I like putting this position on now, being able to manage it as we go forward. We do have a nice run after the CPI number. Then we can look at maybe taking some of this option premium off by selling a call, legging it into a call spread. That might be a way to go. What do you think about that?
Yeah, I love it, Joe. I love it. And, in the future shows next week, we'll continue to update on some of these trade ideas of what we've put on in the past and give you some updates going forward. So please keep tuning in. And speaking of option trading and putting on some ideas and whatnot, we have a big earnings week. Surprisingly, it's the middle of November. You feel like earnings is sort of that, October, we kind of moved out of that, but no, we got Target, we got Walmart coming up. We have some semiconductor big names coming out and network people. And in terms of network, I think it's what's in the news here in terms of security and all basically, what's going on in the world. Palo Alto Networks is one that we've decided to take a look at. And so somewhere in the middle of this show, we always like to give an earnings play. PANW is a symbol that has earnings on Wednesday after the close. Joe, what are you seeing here in the charts, and how do you want to play it?
I see a smiley face. I see it's been a stock that's been just a tremendous winner over the past 3 years. It's a security play, internet security. People are going to need this as much as ever. We're not going backwards. This technology is going to continue to advance. And even with the oncoming AI revolution, we're just going to need more and more of this security. So if you go back and look at this chart over the past 3 years, it's just textbook, exactly what you love to see. It has a run up, period of consolidation, a run up, period of consolidation again and again. Now, really, I see basically the past 6 months of a consolidation here. And we have this nice head and shoulders bottoming formation. We kind of poked above it just a little bit last month, dipped back down, had a little carpet shake, if you will. Now we're back up into that level. I think it's ready. We've had this consolidation. I think we're ready ahead of this earnings event to make the next leg higher.
Yeah. So Joe, do you have a trade? What are you looking at? How are you going to play it heading into Wednesday? Obviously, you're going to probably put something on before the earnings comes out after the close on Wednesday.
Yeah, so went and looked at some of the history and what it does over time. We're actually pricing in an 8% move into earnings, and of course, when earnings come around, options prices are high. They're pretty expensive to do it. So I looked at a call spread. I wanted to play it to the upside. I wanted to make it a little bit cheaper to do so. So I sold an upside call. I'm actually looking out into January. Again, I want to take advantage of this year-end rally. I get the earnings event. Also, if the market does well on CPI, this stock will do well. If the market does well in December, this stock will do well too. So I just want to get into this here ahead of the earnings event. Expect it to run up here. I'm just looking at the 260, 290 call spread. The price of spread is about $10, $10.50. So that'll be $1,000, and it could turn into a little over $2,000. So it's a 2-to-1 payout for me, 2-to-1 risk reward. I really like that risk profile. And, in your trade, I was saying, you'd buy the call now, leg into it. Because options premiums are so high in earnings, the premiums are going to be just gone after the earnings event. So I want to sell the 290 call now ahead of the earnings event. And, if we do get a run up, it won't quite be worth the full $30 right after the event, but it's something I can trade around after the event.
Yeah, and the reason why I kind of like this, when you look at the sort of the break even that Joe laid out on this 260, 290 call spread, I look at past earnings events and I try and dissect what happened before. And when we look sort of every one out of every 3 or 4 quarters, we've really seen enormous moves out of Palo Alto, and those moves being, in excess of literally 15% moves. And so the average move is about 7%. So the option prices are pricing in a little bit higher than your typical move. But if you get that outsourced move or even that 7%, we move up 7% in PANW and you're already above that break even. So I really like to trade because it's kind of, looked at what past earnings have done, figure out where the stock can be. And, this could pay off immediately above that break even point if they turn out to be good earnings. And if they're bad, I don't know, maybe we touch that bottom end of the smiley face and it's upside down. What is it? The clownfish that can flip both ways and swims upside down. So the frown, the smiley can be a frown, right?
Well, I didn't notice that before. Yeah. Okay. It's a pout fish. So it's a popular look. I got young kids. I'm a pout fish with a pout face, and I spread the juries all over the place.
Yeah.
But the good news is, if it turns out right, it turns into a kiss fish, so we'll be okay.
Yeah. All right.
But yeah, I'm with you 100%. The market makers are pricing in. If the market makers are dead on, we're going to be right there on this. I'm going to be right there on this trade. That's what I'm hoping for. And again, I just like the name. I like the market to run through the year. So it's something I'm going to hold through the end of the year. And I like holding it. And probably around January, right when this expires, I think I'm going to want to look to exit it. We'll have to see where we are in the market then. And this is something we'll be following next week. So I'm looking forward to doing that and showing how things go out. And speaking of which, this is an opportunity for you guys to come in and ask questions. You got a question about anything we've talked about so far in this show, feel free to tweet us, put something on the YouTube, whatever. We did get some questions before the show. We'd love to get into it. Brian, you got one specifically. It says, from Truth Teller. Hey, Brian, which is the most practical for an earnings play and best setup and management for? Long calendar at the money using earnings week as short option, double calendar / diagonal, or iron fly, selling a straddle, buying far out of the money wings. Have tried all three and can't pick which is best.
Yeah, I don't think there's necessarily one strategy that is always going to work or not. Obviously, the market can move a lot of different ways. But what I found actually sort of in the past year or so is that we've had these earning events and some stocks have just had enormous moves. That might be wrong, but the play has not been to sell a near-term at the money option. So I really don't like doing that. Like if I buy right at a stock or something of the sort, I usually take that buy right off. I take off those short options. I actually use call spreads or a put spread, depending on which direction my sentiment is. Those tend, just similar to your Palo Alto network trade that you laid out, those are more like binary ways of looking at the market where I'm not worried about option premium either melting away on me or I've got this wrong and there's an enormous move. I can sort of mitigate some of the risk there. So I don't like doing time spreads where I'm buying a long dated option and selling a short dated. When I do that, though, are times where I think the market's going to kind of sit still or that particular stock is going to sit still. I may even do it, for example, one thing I really love doing, let's say the market's dropped down to the downside and I'm looking to add what our option traders, we call it deltas or a long position in the market. I may sell an upside call that's near dated, take in some premium to finance a longer dated call on the upside in order to sort of get upside exposure in that way. So I'm really looking for a sit still kind of market, not an earnings play where I'm going to sell a near dated option. I'm going to do quite differently there. I'm looking at call spreads or put spreads as I head into earnings plays.
I think that's spot on. And for me, it really boils down to For this earnings play, yes, you mentioned stocks that we own. We kind of treat that differently than just a trade for sure. For the trades, for me, it depends on what am I trying to profit off of. Is there a direction I'm trying to profit off of, or is the volatility I'm trying to profit off of? So there's many different ways we can go with the strategy. If we're trying to profit on the volatility, I would say the iron fly is probably a good way to go. You're going to do well if you want to. Either way, you could design it to be long volatility or short volatility. If you're trying to do a directional trade, then we'd be looking at these calendars. Would be my play. And I give an example. I had a directional trade, and I chose a long calendar, or sorry, just a straight long spread. So that's how I would do it. Doesn't always mean it's going to be the way to go, but I think it kind of depends on the situation, as you can see, because there's an option for everything.
There certainly is. And as we, we've had a great show so far. What we like to do sort of like at the end of our shows here is give you a little insight on our sort of tip of the week in terms of a, view from the trader's pits. I wrote a book. I like to give sort of an example of what I did on the trading floor, give a real personal example, or just a situation that we typically see reoccurring in the market and patterns that you should look for to pick up as sort of your tip of the week that you can use here. And so, Joe, at the top of the show, we talked about, what inflation means, what the Federal Reserve does. So what do you have here for us?
Yeah, so we mentioned that we're getting close. If we do get that 0.2 or 0.3, there'll be 5 straight months of that lowered inflation, what the Fed was looking for. If we got to 6, that probably will mean that they are done tightening. They're done with their rate hikes. Well, you go back in time and look what's happened when they're done with their rate hikes. Well, you think about the economic cycle. This is just something we like to do is the Fed tightens. The Fed raises rates when the economy is doing good. That's usually, also a period of time when there's high inflation, because good economy is higher inflation historically. And the other thing the Fed wants to do, of course, is keep unemployment low. But when they raise rates, yes, it does slow inflation down, but it also does raise the unemployment rate. And if you go back in time and think about what happens when they're done raising rates, well, what usually happens is there you have a pause for the Fed, and then they lower rates. Okay, so rates come down, unemployment goes up, and that usually is going to happen within a year or so from the pause. So just from the pits, I remember it quite well. But Brian, you were wheeling and dealing as one of the biggest traders in the VIX pit in 2007. What do you remember was going on at that time?
Yeah, I mean, it was interesting because 2006, 2007, the volatility levels, the spikes, were really down into the lower teens. It was kind of a sleepy market and a sort of grind higher. We started to go sideways, sort of as the typical like topping patterns you'd see in the market with volatility remaining low. Then all of a sudden, one thing I like to look at is when I see spikes making sort of higher lows and the market making sort of higher highs, that might be an indication that institutional traders are out there trying to buy option premium and hedge themselves. These are the big boys, the big players. We saw that a number of times as we sort of headed into that. So I would watch for that really. As you start to see unemployment, looks like maybe, bottom or whatnot, and start to tick higher, look at those unemployment reports, look at what spikes and volatility are doing. Are they ticking higher? Is the market's going higher? Because that might mean people are ready to sort of freak out and volatility explode. Joe, you obviously watch interest rates very closely, the 210. What do you typically see there as another level of indication?
Yeah, and that's critical to something we're going to pin and be watching as we go for the next 6 to 9 months to a year is, yes, the 210 inversion historically has always predicted a recession. That's because the bond traders are predicting the short-term rates to come down before the back turn. Now, when they are inverted, that doesn't necessarily mean bad things for the market. In fact, the market actually does quite well while it's inverted. We've seen that so far in 2023. And when it does revert to the normal shape, it's usually about 6 to 9 months. Then you'll see the recession start. So we have not yet reverted yet. The market's still, historically speaking, steeply inverted. We're we're way less inverted than where we were a month ago, but 40 basis points inversion is still pretty steep on a historical standpoint. So there could potentially still be time for this rally, this mid-inversion rally to continue. Just something we're going to be watching as we go forward. If that 2-year drops below that 10-year, that's something we're going to put a pin in and say maybe we're getting closer to the end.
Well, Joe, this has been a
Wait,
great
I got one more. I got a surprise for you, actually. I don't want to end this yet. So we know, you look at this chart, when the Fed lowers rates, the market actually usually does quite well. Okay, so historically speaking, how many days after the Fed lowers interest rates does the S&P 500 bottom? This is my trivia question. You guys at home can play along too. Put your answers down on YouTube. Take a guess.
Man, how many days later?
How many trading days will the S&P hit a market low after the first Fed cut?
Man, I would say they're probably doing that as the market's rolling over. So I'm going to give it 182 days.
Whoa. Good market, Brian Sutherland. The average is 195 days with a 23.5% drop on average. Not too shabby, but that's what we should expect. Remember, the Fed raising rates last year, the market was freaking out. The market actually does a lot worse when it's lowering rates, and that's usually because the economy is slowing down. So again, something to remember. After the inversion goes back to normal, when we'll get about 6 to 9 months, and then we should be looking at a potential market sell-off again.
See, Joe, you tried to get me here before we closed out the show with this question, and I almost nailed that to the point. I didn't even know we had that slide ready to go. So that's kind of fun. And hey, I still got it.
Still got it. Market maker extraordinaire.
Well, that about wraps up the show on Market Matters here, sponsored by MyX. Thanks to Trader also for broadcasting this, and we love to bring this more every Monday. Tune in, make sure send in your questions in the morning, whatever. We'll try and get to those in the show and update you our trades. Joe?
Yeah, it was a lot of fun, and can't wait till next week.